What three things does Florida have in common with picking stocks? Well, I'll tell you. Hey, before we get going, please hit that like button and the subscribe button. And most importantly, this is not advice. This is only educational. Price action, volatility, and volume. Florida in the summertime is just ridiculous. It's pricey. It's high volume. Lots of people come here for summer vacation. And in some ways, it gets really volatile. Why is this so important? Well, it's the three things you should be considering using when it comes to picking and buying and selling your investment positions. In this video, I'm going to tell you how to use volume, volatility, and price, and how to measure them so that you can make better investment decisions. Volume is a big indicator. A lot of people use it. They couple that with the price action. But what they're missing is that volatility of volatility, vol number. And I believe that is so essential to figuring out if it's a good time to buy a stock or a bad time to buy a stock, or a cryptocurrency or a bond. You can use these three together to create a good indicator of when to buy and when to sell. So let's start with price. It's what everybody looks at, right? Price action, the movement in the stock's price or bond's price or crypto's price. Price is one of those elements that, well, that's what you're trying to make money on, right? So how should you be looking at price of a movement of a stock or bond or crypto or whatever you're buying? Well, there's really a pattern you should look for. When you're looking for upward trends, you should see a movement in the price of the stock where the low of the day is higher than the previous day and the high of the day is higher than the previous day's high. And you see three of those link up like that, and you have now a movement in an upward trend, and that's when you want to own those positions. But then there's the opposite of that, and that's where we see price action, where we see higher lows and lower lows overall, and we see a comparison between the previous day or the previous moment, whatever your time frame is. And when you see a series of those, typically three, you're in a downward trending environment. Now you can blow these things out to, if you're trading a day trader and you're looking at the minute or tick per tick, movement, you were looking for those higher highs, higher lows, and you're comparing them to the previous higher highs and higher lows, or lower highs and lower lows. You following me? Basically, you're looking for a pattern, and when you see a stock sell off and you see it look on a day-to-day point of view, you're looking at that day's low or low and its day's high in comparison to the day before. And if you start to see that pattern, that pivot change where the previous day you had a higher high and a higher low compared to today, then you may be seeing a change in the trend of where that position is going. So always check your price movement. I like to look at a comparison of 3 periods, if it's a day-to-day or a week-to-week or month-to-month. When we're looking at trends, like intermediate trends longer than, say, longer than 3 months, I'm looking for a week-to-week trend or a month-to-month trend. So that way I've got a good view of the overall long-term trend of the position. Then there's volatility. Most people use moving averages, the simple moving average, exponential moving average, and they look at the 20, the 50, the 200, and they base their decisions on that. Moving averages are a look backwards. Where has the market been? What's the average over a period of time? What it's not really looking at is what's going to happen in the future. And volatility is a big indicator of what will happen in the future. What we're looking at is the volatility of volatility. And the way you can measure this is through the implied volatility versus the realized volatility, which you can derive from option contracts. What we're looking for is the premium that people are willing to pay for investment protection or not willing to pay. Here's how we figure that out. We first take the implied volatility number. We then divide it by the realized 30-day implied volatility number, subtract 1, multiply that number times 100. And what that'll give you is the premium that people are willing to pay for protection at that given point in time, or the discount, the lack of premium that people are willing to pay for protection. All right, so once you know if people are paying a premium or a discount for protection against a position, now you take an opposite view. Meaning, if you have a premium over the previous day, previous week, previous month, and people are willing to pay more and more for protection, you take a opposite or contrarian approach. So you're willing to pay a lot for protection, then you go an opposite way, and that means it's bullish to you, and you take a bullish position. Whereas if they're not willing to pay for protection and they're paying only willing to pay a discounted amount, it means they're complacent. It means they're okay with everything. They think it's going to just keep going higher, and that's where you take that contrarian point of view, and this is where you find a overbought position, or you take a short position in this case, or just sell out of your position in general. Then we come down to volume. Volume is always been a part of the indicators. So let's say you have a stock that is moving higher, yet the volume is trailing the previous day's volume. So there's not a lot of volume behind it to push it higher. Chances are it's just floating up to a resistance level, and at some point in the near future, it'll come back down. So you want to see when a stock moves higher after maybe a pivot point or a potential trend reversal, you want to see volume pushing it higher. You want to see volatility declining over the long term, or the, say, intermediate term, say 3 periods of time. Now let's say you have a position that is going higher and the volume is higher than the previous day's volume. Well, then that's an indicator that that stock is getting a lot of institutional or ownership pushing it higher. And that's what you want to see. The same when a stock is going down. When a stock is going down and the volume is higher than the previous day's volume, you are seeing now where the institutions are now selling off in a big way, pushing that stock lower. And that's when, well, you want to get out of the way. But if a stock is going higher and the volume is greater than the previous day's volume, then the chances are that stock will go higher. So when you look at volatility in the same way as looking at increasing or decreasing in volume in comparison to the previous days, it's similar. What you're looking for is a movement higher in volatility. And when you see a higher movement, like higher highs and higher lows compared to the previous day, you see a change in volatility. Movement higher could mean stock is being pressured on the downside. So why do I use these indicators? Because it's math. It's mathematical. It's not my gut. It's not my emotions. It tells me what the market is doing, what people are doing. I do use moving averages at times. The AF5, the 8, the 13 period moving averages. It gives me an idea where in the short term stocks are moving, or bonds, or crypto. But when it really comes down to it, if you can use those 3 indicators, volume, volatility, and price action, and use those in comparison, it gives you a better idea where stocks really are headed, not where they've been.